Welcome to The Explainer. Today, we're going to follow the money in what's got to be one of the world's most complex industries. We're going to trace the journey of a single dollar from a deep-sea drill bit all the way to a corporate balance sheet. Let's break down how oil and gas accounting really works in Malaysia.
This isn't just some philosophical question. It is the central, high-stakes, high-risk financial challenge in the world of oil and gas exploration. So, stick with me, and by the end of this, you'll know exactly how they pull it off.
Okay, so let's dive right in. Before we can even talk about the accounting, you first have to understand who owns the oil and who sets the rules. And in Malaysia, the answer is actually surprisingly simple.
Yeah, it all goes back to the Petroleum Development Act of 1974. Because of that law, one single entity has exclusive ownership and control over all of it, the national oil company, Petronas. This makes them the ultimate gatekeeper, the central figure in this whole story. Any company that wants to drill here has to play by their rules.
So how are those rules laid out? Well, it's all in this critical document, the Production Sharing Contract, or PSC for short. You can think of it as the master rule book for any oil and gas project. It defines absolutely everything, especially how the costs get paid back and how the profits get split. This thing is the foundation for all the accounting that comes later.
But here's where it gets interesting. Not all contracts are created equal. You've got two main flavors. Under a conventional PSC, a big company like Shell or ExxonMobil puts up its own cash, takes on all the risk, but if they strike oil, they get to own a share of it. Now, under an RSC, it's different. They act more like a highly paid specialist. They get paid a fee for their work, but Petronas keeps 100% of whatever they find. It's all about different risk for a different reward.
All right, let's move on to the first, and let's be honest, the riskiest part of the journey. That super expensive search for oil and gas. This is the stage that feels a lot more like a high-stakes treasure hunt than a normal business. And you guessed it, it has its own unique accounting rules.
So the official rule book for this treasure hunt phase is a standard called MFRS 6. It's specifically designed to handle the massive financial uncertainty of, looking for something that might not even be there.
And here's the accounting magic trick. Instead of treating the hundreds of millions of dollars you spend on seismic surveys and drilling test wells as an immediate expense, which would just wipe out your profits, MFRS 6 lets you bundle all those costs together. You get to record them on your books as a temporary asset called an E&E asset.
Okay, but that brings us right back to that billion-dollar question we started with. What happens to that asset if the treasure hunt comes up empty, right? You can't just keep a failed project on your books forever and pretend it's valuable.
And MFS 6 is super strict about this. It sets up very specific triggers. If a company gives up its rights to explore, decides to stop drilling in that area, or just plain can't find enough to make it commercially viable, it's forced to check if that E&E asset is impaired. And in most cases, that means writing its value all the way down to zero, which can cause a massive one-time hit to the company's profits. Ouch. But what about the good news? What happens when the hunt is a success? Let's look at what happens when they do find commercially viable reserves and the project shifts gears from just exploring to full-blown development and production.
In this table, it lays out the whole accounting journey perfectly. You can see exactly how the way costs are treated changes with each stage. And that temporary E&E asset we just talked about, well, it's about to go through a pretty big transformation.
The moment a discovery is proven to be a sure thing, that E&E asset gets reclassified. All the money they spend from that point on, building those massive offshore platforms, drilling the actual production wells, laying pipelines, all of it gets capitalized as property, plant, and equipment, or PPE. It's no longer a temporary bet. It's now a solid, long-term, revenue-generating machine.
Okay, but get this. Here's a fascinating twist in the rules. Even as they're building these giant structures, another rule, MFRS 37, forces them to look decades into the future. From day one, they have to estimate what it will cost to eventually take everything down and clean up the site, and they have to book that future cost as a liability today. This makes sure those huge end-of-life costs don't just get forgotten about.
Okay, so the company now has this giant multi-billion-dollar asset on its books, and the oil is finally flowing. So how do they match the cost of that asset against the money they're making? I mean, they can't just expense it all in year one.
Well, the answer the industry came up with is actually pretty clever. It's called the Unit of Production Method, or UOP. Now, unlike depreciating, say, an office building over 30 years, UOP isn't based on time at all. It's based on how much oil you actually pull out of the ground.
And it works in three really logical steps.
First, you take the total cost of your platform and your wells. Second, you divide that huge number by the total barrels of oil you think are in the field. That gives you a cost per barrel. And finally, you just multiply that rate by the number of barrels you produce this year. And that's your depreciation expense for the year. Simple.
This simple formula, it's basically the engine room of oil and gas accounting. It perfectly matches the expense of the asset with the revenue it's generating. So if you produce a lot of oil, you record a lot of depreciation. If production slows down, your depreciation charge slows down right along with it. Makes perfect sense.
So we've got the assets, the liabilities, the expenses. We've got the numbers. But in an industry that's literally built on estimates of what's buried miles beneath the ocean floor, how can an investor ever really understand the full story behind those numbers?
Well, this is where the fine print becomes the main event. The numbers you see on the balance sheet and the income statement, they're just the headlines. The real story, the context, the risks, all of that is found in the notes to the financial statements, in the disclosures.
And what should you be looking for in there? This is the good stuff. Critical details, like the company's own reserve estimates. That's the total reserves number that drives the entire UOP calculation. You'll also find details on their big PSCs, how much they're committed to spending in the future, and the assumptions behind that huge decommissioning liability we talked about.
I mean, it really boils down to this. Without these detailed disclosures, the financial statements just can't give you a true and fair view. This level of transparency is absolutely non-negotiable if you want to understand the real health and future of an oil and gas company.
Which leaves us with one final and kind of provocative thought. This entire logical accounting system is built on a foundation of assumptions. Assumptions about future production and, most importantly, future prices. So, if those prices suddenly collapse, how quickly can a multi-billion-dollar asset on paper become a massive liability in the real world? It's the constant tension at the very heart of oil and gas finance. Thanks for joining me on The Explainer.